Welcome back to another episode of your favorite show. Erlis, what's the name?
The reality hits the fan.
He finally got it.
I remember.
Yes. This is my favorite episode already. It's just
Because I remember?
That moment alone.
Because I remember the name of our...
Cool.
That's funny.
Guys, we have some great information for you. You want to buy a house and you don't have any income, don't show any income? We got something for you. My good friend here, Erlis, is going to share this information with you. I'm going to chime in from time to time, but he's the master with this. He loves this product all day long, twice on Sundays. Erlis, should we give him a little bit of insight on what we're doing, what we're talking about?
Sure, why not? I mean, we're a wealth of information. We're willing to share it with whoever wants to listen. And of course, you can reach out to us, which we'll share our contact information with you later on in the episode. But thanks again for joining us. This is what episode is it? Do you remember?
14, 15.
So 14. I think it's the 14th.
15.
It's
15.
the 15th. It's episode 15. We've had great results. We've had some amazing agents and friends that have joined us through the process. We've had a lot of support from our team here at MVM Group. So it's been a fun journey, to say the least.
Yeah,
You know?
and it's just starting.
Yeah, perfect.
Okay.
So again, this is year 2023. We have some exciting news. Just like Leon shared, we want to share one of our products that it's been extremely helpful for those who want to purchase an investment property. So the key word, investment property.
Investment property. Okay, so guys, take note of that. This is not your first time home buyer product. This is if you're looking to buy another property. All right.
Good. So let's get started. So the program itself, it's called DSCR, and I'll break it down for you what DSCR stands for. So it's debt service coverage ratio. So what does that? Sounds very confusing. It's a mouthful. DSCR, debt coverage,
definitely a
debt
tongue
service
twister.
coverage ratio. It's a mouthful. So let me kind of break it down slowly so we can all, kind of get a better understanding of it. What it truly is let's say you purchase an investment property, right? And this investment property is going to be rented out, right? And the rent that you will be collecting during a month or a given month, it has to equal what the monthly payment will be towards your mortgage. So principal, interest, taxes, insurance, and homeowners or HOA for that matter. So I'll re-explain it. So you're renting out a property, and this is the investment property that you're purchasing it. And this, let's say the rent is $2,000 a month. Let's just use an example, right? You collect $2,000 a month from the tenant that's going to be occupying your investment property. Now, if that $2,000 satisfies, right, the mortgage payment, the taxes payment, the insurance, and the HOA, you have yourself a home, right? And to get this product, right, you don't have to show any income, right? I said it. You don't have to show any type of income as long as the rental pays for the housing expense. You got yourself a property to call an investment home. How easy was that?
Seems really easy to me. It
Right.
almost sounds too good to be true.
It's a no-brainer. Truly,
So-
it's a no-brainer.
I just want to make sure I understood that, right? For our layman's people out here, including myself. What you need is your rent to cover your mortgage. So if your mortgage is $2,000, your rent needs to be $2,000. Correct?
Exactly.
That simple. Bam, and you have yourself a house.
1-to-1.
Okay.
So if you take the $2,000 and you divide it by your mortgage payment, right? So $2,000 is your rent that you're collecting from your tenant, and $2,000 is the monthly payment you're making towards your mortgage, right? Towards your taxes, towards your insurance, everything combined, you're set. If the rental is $2,000 that you're collecting, but the mortgage payment, let's say it's $1,800, you win. It's still a win, So now what I want to explain is, how do you know how much your rent is going to be when you purchase an investment property? Because you don't own the property yet, right?
Definitely.
The
Correct.
property is still owned by somebody else. So Let me give you a better explanation. So when we send out the appraiser to value the property that you are going to be purchasing, we advise the appraiser to do a rental analysis for that particular unit. So we know right off the bat what the property will be renting for, right before you purchase it. So you'd have a general or a good idea what to rent it for because we have the appraiser's opinion. So it makes it very simple for myself and for you to make a decision on how much to rent it for moving forward. So that's pretty simple.
Makes sense.
Yeah. So it's a good guiding tool to have an appraiser do the, to give you a general idea of what the property could rent for. I mean, you can rent it out for as much as you want.
Yeah.
So you're not really controlled to rent the property based on the appraiser's opinion. You can rent if the appraiser says this property can rent for $2,000, but you believe that once you purchase the property, you believe that it's going for $3,000. Go ahead, go right ahead. Mm-hmm. Right?
Erlis, tell me, do anybody looking into this product, do they have to be an investor already? Do they need a background in real estate investment? That's
a great question, by the way. So, first thing first, in order to purchase an investment property, you must show me 12 months of rent payments if you're renting your residence where you live today, or you must have 12 months of mortgage payments. So you don't necessarily have to own your primary residence to purchase an investment property. So this is an awesome product.
Okay.
Very nice. So you can show, if you're, let's say you live in New York and you're renting a property, right? You're not living rent free. This is not for rent free, right? You must be renting and you must have lived in there for 12 months. And I need to see verification of rent, and it has to come from your, let's say your landlord. If you rent a property, you've been there for 12 months, or if you own a property, you've lived there for 12 months, you paid your mortgage for the last 12 months, you're good to go. You can purchase an investment property.
That's amazing.
It's awesome.
So you don't even need to own a property. You can just buy an investment.
Yeah. I've done a few deals where the borrowers didn't own their primary residence. They lived in New York, and they wanted to buy a house in Naples as an investment property. No problem whatsoever. No income. However, they are required to put 20% down.
Oh, okay. You stole the words out of my mouth. I have a thing against all these Instagram clips.
Tell me.
That bait you into something, but they don't give you a full story.
Right.
So I know us personally, we always want to give you everything, right? The good, the bad, the ugly. So we're going to help you get from point A to point B, but we're going to do it truthfully and
honesty.
Yeah,
we're very transparent. We've been very transparent from the beginning. So 20% down on an investment property, it's a win-win.
Yeah, and it's also very standard, right? It's not going above and beyond. It's not like our good friend Mr. Bill Cacho, who likes to interrupt our podcast with his phone on loud. Bill, say hi to the people.
Yeah. Hello. And I've showed Bill how to silence his watch, but he chooses not to follow my leadership.
Y'all getting on me? No. Y'all leaving a few things out.
Oh, according to Mr. Bill Cacho, we're leaving some things out, and we want to make sure that we're not doing that.
Okay.
So.
Reserves.
Right. So, reserves. We didn't get there. But that's okay. We'll talk about the reserve. So we're trying to build the program from the ground up. So we told you that you don't need any income to purchase the property, right? You don't have to show any type of income. We also told you how the rent is calculated, right? We also told you that this doesn't have to be your primary residence. You don't have to own your home in order to purchase an investment property. It can be purchased anywhere in the country. You can live, let's say in Michigan, you can purchase an investment property in the state of Florida. That's no problem. Same scenario, same guidelines. We also told you that you can put 20% or more down, and the cutoff is at 20%. Correct. And our colleague Bill mentioned the reserve. So what does reserves? What does that mean?
So reserves is having a safety cushion, right? You have X amount of dollars in your bank account to cover typically 6 months worth of mortgage payment, right? So if your mortgage payment is $2,000, you multiply that by 6, that's your 6 months of reserves that we're looking for.
Awesome. So, in other words, you purchase it. Let me use a scenario. It's probably better to understand it that way. So let's say we're buying a property for $100,000. Let's use small numbers for the sake of the conversation. And you are required to put 20% down. So now you're going to borrow $80,000.
Correct.
Right, 80,000. Your monthly payment. Let's just use an example. This is your principal, interest, taxes, insurance. Right. Let's say they're $1,500. Right, so you're buying a house for $100,000. You're putting 20% down. You're going to borrow $80,000, and your monthly payment for what you borrowed, including tax and insurance, is $1,500. So what Leon just mentioned is that you are going to need 6 months of reserves. So you need $1,500 times 6 to have in your bank account in order to purchase an investment property. Right, and this is in addition to the 20% down.
Correct.
All right. Does it make sense?
Makes sense to me.
So it's simple, it's easy, and because we live in Florida, we actually live in Naples, Florida. The rental market here is
On fire.
on fire. On fire.
We have a guest question here. Hold on. Sir, I can't really make out your name back there. Mr. Bill Cacho. Oh, we're back again.
We're back again. I have another question.
Yes,
Tell
sir.
What are the credit requirements in order to be able to qualify for the DSCR loan?
Perfect. So we can go as low as 620. But there's a but, and we promise to be honest and tell you the truth from the day we launched this podcast. So at 620, if you have a credit score of 620, then you are required to put 30% down.
Correct.
640 and up, you can put 20% down, right? Because why is it different? Why do I have to put 30% down if my credit score is 620? Well,
640, 660.
620. 620 is 30% down, and 640. I'm sorry, 6. If you have a 620 credit score, you are required to put 30% down. If
Correct.
you have a 640 credit score, you can put as little as 20% down.
Okay.
Right? So why the difference? Well, I'm going to be honest, it's the risk factor, right? So at 620, there is some work that you need to be doing, to repair your credit score. That's why they require a little bit more skin in the game. Nothing to it, right? Remember, the investment property, it's the property that you own. You can rent it out and sell if you really want to, right? So it's yours to keep. So we covered the program. We covered how to purchase it, what down payments will be. We use scenarios, right? What reserves are, right? The credit score. And let's see, am I leaving anything out? Okay, the gentleman back there, he has another question.
I have another question. I would like to know, is there a prepayment penalty associated with this loan?
Right. So, can I take that one?
Right
So,
ahead.
To answer your question, yes. In the state of Florida, there is a prepayment penalty. Different states have different guidelines. So Ohio, for an example, they do not have a prepayment penalty, right? So if the lender wants to do business in the state of Ohio, for example, they are required to meet their guidelines, state guidelines. And the state guidelines outline that you cannot charge somebody who wants to buy a property here a prepayment penalty. So before we get the prepayment penalty, what is a prepayment penalty?
Prepayment penalty is what the lender or the servicer is going to charge you to break basically that contract that you have. So you signed for 30 years. They're saying we need you to stay with us for a minimum of typically 2, 3, 5 years. It all depends on the lender and the terms required in your financing contract. And then if you break before that, you pay whatever's that penalty is. Usually like
6 months interest.
6 months. 6 months, according to Mr. Bill Cacho, who actually asked the question.
Yes.
He also answers his questions.
It's
Those are my
different.
favorite type of people.
Yeah.
Yeah. So yeah, prepayment penalties, they're pretty standard. There's nothing unnormal or uncommon. It's just something that you want to look at and you want to plan that into if this is a long-term thing or a short-term thing.
Beautiful.
Right?
So, to answer Bill's question, yes, there is a prepayment penalty. And Nothing wrong with it, right? So the prepayment penalties come in different scenarios, and the prepayment penalties actually help you, stay on task. What do I mean by it? So let me first define the term of prepayment penalty. There is a 5-year, 4-year, 3-year, 2-year, and a year prepayment penalty, right? So if you choose to go with the 5-year prepayment penalty, which means that if you choose to pay your mortgage off or refinance it before the 5 years is up, right, you will get hit with a 5% of the balance, the loan balance. So it does get a little bit tricky, right? Do they have other options in place? Of course. So myself and Leon, we are going to explain this to you. So in the event that you choose to purchase an investment property and you use a program similar to what we're explaining, then we're going to guide you to make the best decision, right? You don't have to do the 5-year prepayment penalty. You're not obligated to choose 5 years. You can choose 1 year if you really wanted to. So why do they do 1 to 5? Why do lenders have a prepayment penalty in place? Well, first and foremost, they want to keep you with them. That's number one. And number two, the interest is in your favor if you choose a long-term prepayment penalty. So if you choose a 5-year prepayment penalty, the interest rates will be much better, much more favorable versus a 1-year prepayment penalty. So I hope you understand how that works. So 5-year prepayment penalty, if you pay your mortgage off before 5 years is up, right? So if you pay, let's say, year one, you pay 5% of the loan balance, right? Whatever the balance is at the end of at year one. If you pay the balance off year two, you pay 4%, right? Penalty of the loan balance. So 4% of 100,000 is $4,000. That's an example. If you pay your loan off third year, right, then you pay 3% of a loan balance. Second year, 2% of a loan balance, and you pay it on the fifth year. If you pay it on the fifth year, your loan off, then you pay only 1% of a loan balance. If you pay it after 5 years, there's no prepayment penalty, right? So the same scenario applies to 4-year, 3-year, 2-year, or 1-year prepayment penalty. It's not as complicated. We are going to break this down for you. We're going to explain it to you. It's a very simple concept to understand. So please don't get confused. Yes, it's a mouthful. Yes, it's a lot of information, but that's why we are here.
Yeah, we'll have to definitely break that down a little bit more for people on another episode, right? That way we can go more in depth, really tell you what to look for, how to calculate, what factors to consider, and we'll kind of take it from there. That's a great another episode, I think.
Yes, absolutely. Prepayment penalties are not something to hold you back. Please don't look at them as a way of not helping you move forward. A prepayment penalty is just put in place from the lender, so you choose how you want to move forward. Don't let that guide you. It's not it. Myself and Leon, we are your guiding place. We're going to help you. We're going to hold your hand from the beginning to the end of the process, just like we are right now. So please stay with us. Stick with us. We got you.
So before we end here, my favorite part of the show.
Go ahead.
Erlis, what's that one piece of advice that you would give a client, borrower, friend, family?
Right now. So one piece of advice, and I just gave it to someone 15 minutes ago as I'm driving to work. So that advice is this. Take advantage of the time, your age. We're not getting younger. If you want to buy a property, please don't overthink it. Yes, do your due diligence. Yes, consult with myself and Leon. Yes, consult with family members. But remember, we're not getting younger, right? Purchase a property, turn it into an investment property. Don't look back, because the property is going to pay you twofold. It is true. I personally own multiple properties in Naples, Florida, and I can tell you, my dad told me not to move forward, and I did it anyway. And I can't tell you how beneficial it has been for me. And I don't plan on selling any of them anytime soon. So my advice to you, please consider this option. If there is a way to purchase an investment property with putting very little skin in the game or very little money in the game, do it. Don't sit back. This is your time to shine. Did I answer that question?
I absolutely love it.
Perfect.
Cool. All right, guys. Till next time. Erlis, where can they find us?
So You can find us at our website. It's mvmgrp.com, right? mvmgrp.com. That is our website where you'll find my personal information as well as Leon's. It's easy to to look at. Just click. You find our pictures, our contact information, even our social media point of contact. So please reach out to us. We'd be more than happy to answer questions, whether it's on the phone, in office, or through our social media platforms. See you soon.
All right, guys.